Are you approaching retirement and concerned about the amount of your hard-earned savings dollars that are going to go towards income taxes while you're retired? The bad news is that income taxes are a part of life. They're a part of life while you're working, and they're also a part of life while you're retired. In fact, income taxes may be one of the larger line items in your household budget, even while you move through retirement. The good news is that you have a lot of control over the timing, amounts, and type of withdrawals that you make from your investment accounts throughout your retirement. And by doing that, you have the chance to lower your lifetime tax bill. And in this video, I'm going to walk through an example of how our sample couple, we're going to call them Johnny and Janey, were able to save taxes by making a very small tweak to their withdrawal plans. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people who are preparing for retirement or who are currently retired. And I created this channel to share ideas, concepts, and strategies that I'm using with my clients every single day as they move through retirement. And I hope that some of these ideas are helpful to you. And if you want to get more videos like these, consider subscribing to the channel so that you get new videos to the top of your feed. And now we'll dive into our example. So I'm going to share my screen with you. As I mentioned, our friends Johnny and Janey, they just retired in the fall of 2022. Before they retired, they were each working and earning an income of around $100,000 before taxes. They live in Ontario. A quick snapshot of their assets. So they each have $750,000 in RSP accounts. They each have $100,000 in tax-free savings accounts. They each have $50,000 in non-registered accounts, and they own their home. So they have total assets of $2.8 million. Now, they retired in September of 2022, so their taxable income in 2022 was $135,000. Using a really simple tax calculator, I'll link to it below. It's from taxtips.ca. It's a fantastic resource. I put in their incomes for 2022, and it showed that they paid around $24,210 of tax last year, which resulted in an 18% average tax rate. The first year of retirement is 2023. Their taxable income they expect to be significantly lower. It's going to be $50,000 combined in 2023. And using the same calculator, I estimate that their income tax bill this year will be $5,126 and a much lower average tax rate of 10%. And this is a very important detail as we move through the example. Their average tax rate while they're still working is significantly higher than their average tax rate now that they're retired. And this is important information as we plan out withdrawals as we move through retirement. Now let's pretend that Johnny and Janey went to their advisor late in the year 2022 and said, we want to make a $10,000 withdrawal from our RSP accounts. It was an unplanned expense. It wasn't in their financial plan. They decided to maybe splurge and go on a holiday or maybe give a gift to a loved one like a child. And so they called their planner and said, we'd like to make this $10,000 withdrawal and we'd like to take that withdrawal from RSP accounts. So their planner listened to their question and then thought, maybe there's an opportunity for us to save some taxes. So what I'm going to do is I'm going to show you what would have happened had they proceeded with that $10,000 withdrawal in 2022. So we'll start there. So if they proceeded with that withdrawal at the end of last year, it would have added $10,000 of income to their household tax bill. Let's say that they split that $10,000 withdrawal down the middle. They each took $5,000 out of their RSPs. It would have resulted in their total tax bill in 2022 going from $24,210 up to $27,196, or an extra $2,986 in taxes on their 2022 tax bill by making that $10,000 withdrawal at the end of 2022. But their planner said, hold on a sec. We know that next year your incomes are going to be much lower. We know that your tax rates, the brackets that you're going to be in 2023 are going to be lower. Why don't we simply hold off on making that withdrawal until the calendar flips over to 2023? And so the financial planner may have done some simple projections. We now have the benefit of having a 2023 tax calculator. So I'm going to show you what the impact of that simple delay of a couple of months of making that RSP withdrawal would have meant to Johnny and Janey's plan. So let's take a look at 2023 and the impact of moving that withdrawal out a couple of months from the end of 2022 over to 2023. So we're going to have $10,000 of additional income. That's going to result in a tax bill in 2023 of $6,932, or 1,806 additional tax dollars versus what we already had planned for 2023. And the savings, the net savings between these two options is $1,180. So said differently, what that means is simply by delaying that planned or that unplanned $10,000 RSP withdrawal, moving it from the 2022 tax year over to the 2023 tax year, resulted in a savings of $1,180 of tax, just simply by making that slight delay or taking a little bit longer to process that withdrawal. Now, let's say that Johnny and Janey didn't want to go ahead with that plan. What are some other things that they could do? Well, in their case, their planner may have suggested this, but they could avoid making the withdrawal from the RSP altogether. They have tax-free savings accounts, so they can make a withdrawal from their tax-free savings accounts. Recall that dollars that go into tax-free savings accounts are after-tax dollars. They grow tax-sheltered and they come out tax-free, so there's no taxes to pay. So if we don't want to increase their tax bill in 2022, but they're dead set that they have to get this money in 2022, tax-free savings accounts would be one place where they could go. Of course, they could also go to their non-registered accounts. So non-registered accounts may increase their tax bill if they have unrealized capital gains that will be added to their taxable income in 2022, but certainly not as much tax would result from a non-registered withdrawal as would result from an RSP withdrawal. But let's imagine for the moment that Johnny and Janey only have RSPs. They don't have TFSAs, they don't have non-registered accounts. The other thing that a planner might suggest to them is maybe borrow the money on a short-term basis. Now, borrowing money in retirement, it seems like kind of a faux pas, and where it can be avoided, we want to try and avoid it. But in order to save this amount of taxes, $1,180 on a $10,000 withdrawal, it may make sense for them to borrow from, say, like a home equity line of credit for a couple of months, simply so that they can move that withdrawal from calendar 2022 over to 2023 and save this amount on income taxes. Of course, they're going to have to pay a little bit of interest while they borrow money from the home equity line of credit, but I would be surprised if it added up to be more than the potential savings in income taxes by delaying that withdrawal. So hopefully this example has helped illustrate the power and control that retirees have over the timing and type of withdrawals that they make from their investment accounts. And by doing that, they can help manage their tax bill or manage down their tax bill throughout retirement. I hope that you found this video to be helpful. If you like it, consider giving it a thumbs up. Consider subscribing to the channel if you'd like to get more retirement planning videos like these. I've put a number of resources in the description area below that you're welcome to, and hopefully they'll help you as you prepare for retirement. Thanks for watching this video, and I'll speak with you soon. Take care.